And okay, Hans, I see you. Are,
I think I just started
yeah.
recording.
All right, looks good. So, all right, I'm ready to start. Just double checking everything. Okay. All right, I'm starting now. All right. Hi, everyone. Welcome to the timingresearch.com crowd forecast news for February 10th, 2025. We are recording this at 1 p.m. Eastern Time, and this is episode number 465. So today I've arranged for Hans Albrecht to join us again of crushthepremium.com, and Jim, the option professor of optionprofessor.com, is back to moderate. So I'm going to go ahead and turn it over to him.
Okay, thanks a lot, David. And Hans, good to be with you here. With regards to what we're going to cover, let's go over, start out by just starting with the S&P. On the screen here, I put up the E-mini for March. Do you follow the E-mini, don't you?
Yeah, yeah,
Okay.
definitely.
So do you have an opinion on we're at 2085, 6085 here? We're up pretty sharply on the morning here. And did you have any feelings on where you think we're going? And how do you
Well,
feel
I
about
mean,
it?
I think the market just keeps shrugging off, bad news, but I think it's realizing is that it's not necessarily that bad. It's sort of the art of the deal, right? So that you can see the market's getting a little less sensitive to some of the rhetoric. Not that there isn't some concern behind some of that, right? We don't want a protracted trade war. There's certain things that could definitely upset the apple cart here. But I think generally speaking, I think you can kind of feel that there's really sort of embedded strength in this market, and it will pause occasionally, as we've done the last couple Fridays, pretty much the end of the week, into over the last 3 weeks, really into DeepSeek news, into the tariff news. VIX is becoming just a little less sensitive, which is interesting to me because since August, we really had kind of a high beta of the fear index to sell-offs in the S&P. And what that means
What's
is
his name?
you're getting this sort of very nervous, sort of like the cat in the room full of rocking chairs, that very nervousness to any kind of sell-off. We've seen that sort of dissipate a little bit over the few months, which on the one hand makes a little bit of sense because as August and September, sort of become more and more in the distance, then we sort of get back to a little bit more of a normalized volatility environment. So while we are still a little bit on the high side, VIX 1579 is certainly not something that you would associate with markets hitting pretty close to all-time highs, although we still have a little bit of work to do. I feel that the pain point is still up. I just do. That's sort of my personal feeling. I know some people, some very, very smart people disagree with that, but I think we can make our way right back to the old highs. I think eventually the glass half full sort of plays into it. And while there are some issues, tariffs, I've said, have always been kind of this front loaded problem, whereas, the tax cuts are a little bit more back end loaded. I think ultimately inflation does not rear its ugly head to too much of an extent, and we start to consider the fact that maybe second half of the year we get some rate cuts. And so we'll talk about some of the plays that make sense against that backdrop.
Yeah. Well, yeah, I was wondering, do you have much of a feeling on the CPI that's coming out on Wednesday? Oh, shoot.
Oh my goodness, that sounded like
I,
firecrackers.
well, I dropped my keyboard. Sorry about that. I had it on my lap. Sorry about that.
I
So
don't
anyway,
think
yeah. What do you think, CBI?
Yeah, I don't think I'm not super concerned. I know that's sort of the narrative, right? So I always try to think of markets as trading at the very margin of the current narrative, right? It's sort, we always try to kind of embed the market is male, as I like to say, it can think about one thing at a time. And so it's sort
Mhm.
of that, now I think we've kind of had this resurgence and okay, maybe we have a bit of higher for longer in terms of rates, and maybe we're starting to worry a little bit about inflation and how that may impact things. But I think generally speaking, I mean, I don't think this is the world that some of us have been used to. Now, some of the listeners will have been around for 3 years, and some will have been around for decades, like myself. Um, and a reasonable level of inflation and a reasonable level of interest rates, it shouldn't really be that concerning. So I don't think we go back to this sort of period of 2000 to 2015, let's say maybe earlier than 2000. The world has changed. We were very fortunate to be in this world of cheap, very skilled labor from places like China. That really fed into our, desire for things, $300-400 flat screens and everything else. We really benefited from this kind of world of cheap goods and low inflation, these sort of things that kept inflationary forces down. Now it's a different reality, right? We've created a lot of wealth in the world in places like China. Wages are way up versus 10 years ago and 20 years ago. Now we've got a lot of people in the world that compete for the same resources that we want. So that should put a bit of a floor in some of the input costs, in some commodities. And I think the days of super low inflation are just almost structurally are gone. And so we just kind of have to get used to that. And I think that's something markets can get used to. In fact, markets aren't a bad place to be when there's a reasonable amount of inflation. Now, if we push up to 5% again, that's a problem. But I don't know how you feel about that, Jim, but it's, we could experience a little bit of an environment that really markets can get used to, as long as things don't get to extremes. We need that porridge to be warm, right? We don't want it to be extra hot. We don't want it to be extra cold. The market likes things sort of just down the middle.
Right. And of course, the jobs report did get people nervous about inflation because of the big jump in wages. So that's what puts such importance on Wednesday's number, I think.
Yeah. Look,
Because
and we're data dependent. There's no question. We're going to be data dependent.
yeah.
Powell has no clue what he's doing, so he's just watching the data as well. Um, and but we heard from Kashkari, and he said, he kind of hinted that, we'll watch things, but you can just tell they're chomping at the bit to lower rates. And so,
Yeah. No, there's no doubt about it. And the thing is that I'm going to put up the 10-year note here, and that'll give people a good perspective on what the yield looks like and what the trend of the yield looks like, because people don't really know this because they don't really look at something like this very often. And so, because we are such good webinistas, we're going to show them that. So, give me a second here.
well, we got to give you guys the full enchilada, and you're right. I mean, look, stocks compete with rates. And so we were how high did we get there? We got around 475, kind of
Yeah,
pushed up a little bit in the 10-year. And then so at some point, as you push five, people go, you know what, I can make a little money risk free. And
yeah.
that becomes an issue for stocks a little bit.
David, are you still there?
Yeah. Yeah.
I'm having a little bit of difficulty with my screen here, as far as the keyboard, maybe because it fell off my lap here. And so I'm wondering if you could put your screen up, and I could give you some symbols and we could talk through your screen.
Sure. Yeah.
Yeah.
Hold on.
Sorry about that. I guess when I dropped it, it was a problem. I'll find out what the problem is after the seminar. But yeah, because I had some stocks that I thought were looking pretty good. We were going to talk about the 10-year note. That's TNX on my screen, or $ TNX.
Wait a second. Okay, can you see my screen now?
Do I have to stop sharing? Probably, right?
Yeah, I turned that off already.
Okay.
You see my screen now, right?
I'm not seeing it yet. Hans, are you seeing his screen?
I see Palantir on the screen, actually. Yeah.
Okay.
Jim, it's probably under something on your screen.
Okay, I see it on. Yeah, I see it now. I'm sorry. Oh yeah. Okay.
The 10-year note is what you wanted to see, right?
Yeah.
Is that does that work?
I can. It's still this. Yeah. There's the 10-year. Yeah.
Okay, so on the 10-year, Hans, can you see that it came down to 360, then it went up to 380, then it came back towards 420, 450, and now we're right in that same neighborhood. So my view is if we get above 460 again, it might take out 480 and get moving. If it ever gets under 420, you could actually see rates start coming down. Do you see the same kind of range?
I do. Yeah, I agree. That's yeah, and that's it. And so, you know, that's where I think the kind of we're in that sort of warm porridge environment. As long as we're kind of under 450, I agree. 460 starts to get you a little worried again. And then down to 360, maybe that isn't, super great either. But I think it's at the moment you're kind of you've seen a nice bounce in TLT, which I have my doubts as to whether that continues or not. But I think, generally speaking, I think the environment, you've got very strong numbers. All the data that I'm looking at is quite strong from a consumer perspective, from an employment perspective, inflation. So there's certain things that markets can't handle, and I think there's certain things that markets can handle as long as the foundational elements are there, which is people have jobs, which is inflation doesn't get too crazy, and GDP and the growth is good, right? So all the naysayers for growth have been wrong for years now, and I think that's partially because the whole transition mechanism for rates hasn't really worked, right? I mean, we've had this big jump in rates, and yet it hasn't slowed down the economy. Well, the problem is houses have gone up bananas. So you've got house equity up 80% over 4 or 5 years. You've got people who've locked in, you've got corporations that locked in low rates. You've got individuals that have locked in at low rates, low mortgage rates. So people are still rich. So that whole transmission mechanism of, well, we're going to raise rates to kind of, we're worried that might slow things down. It just hasn't really worked out that way. So it's very interesting to see how things don't always, work out as people expect. But for now, until we run into kind of a refinance wall, I think things are generally pretty okay. I don't know. What do you think, Jim?
Well, like I say, I'm just going to play the way it goes because, like I say, if the inflation CPI number starts picking up, and the job, we already know people have plenty of money because we just saw their wages, and we saw 4% unemployment. So I think there's no doubt people have money and people are employed, and that makes them confident. The fact that the stock market has remained up also makes them confident. And if
Yeah.
they're out there spending money, I don't know who's going to lower their prices on anything. So that's why, I think there is a risk on the inflation front from the standpoint of you know the fact that there's so much money out there, so much. Look at a firm and Upstart, the companies that loan money to let's call the impoverished or something. Uh,
Yeah.
they are all on fire. So I mean, I don't know how you're going to get prices to come down very much. Now, oil did take a nice break from $81 down to $71, so that might help a little bit. But I still think there's some risk to the inflation, and the fact that inflation is not killed is not a problem. But you know, like you say, the market can probably handle a higher interest rate because, again, of all the things we just mentioned. Gold is definitely taking off. China is just loading up on the gold like there's no tomorrow. Let's put up GCG or GCJ, and let's take a look at gold because obviously I thought it was a great deal as soon as it broke above 2650, but now we're up at 29 and change. So, but there was a big announcement over the weekend of China really loading up on it again. So that's obviously was a stimulant to the price.
What are you trying to show?
Gold,
Oh,
gold.
okay.
Anything that
Yeah.
says gold on it. I
Yeah.
mean,
Okay. This is mine.
we're talking generically on this. Yeah. And I wanted to get an opinion from Hans on what he thinks gold might do, because obviously it looks like it wants to blow out 3,000.
Yeah, I mean, I think that's a recognition that it's not really, it's business as usual, which is uh, quite, they may have a little trouble with this DOGE. They're going to make it look good. They're going to, throw up a few headlines that embarrass the previous administration that's spending $1 million on studies that help people to match up their socks or whatever it is that you're hearing about out there. All the stupid waste that probably happens in any government. So, maybe there's some, they offered people buyouts, then not many people took them. So I don't know. There's some ability for them to maybe cut. I mean, it's like a corporation. You can improve things by either increasing profits or cutting costs. And cutting costs is a really easy thing to do. That's a nice way to move the needle for executives, at least. Fire people, but it remains to be seen whether Elon and company can pull something like that off. In the meantime, it probably is business as usual, which is, probably spending too much money, and that kind of thing plays into gold. That's a heck of a run that it's had um, recently. If you drew that sort of triangle there, that pennant pattern, it's just blasted off through there. Silver's kind of had a little trouble though playing catch up, although we have to always obviously admit that it's a different animal.
It
Um,
is a different animal, but it,
yeah.
generally will follow at some point in time.
But yeah, you're
But
starting to see copper start to break out. Copper, look at that copper chart. I mean, it's going bananas as well. So there's definitely there's a narrative developing. That's without China really participating. So imagine if China can get it.
yeah, well, I think some people might be front running that concept, maybe.
Right. Yeah, you might be right. So,
Well, like I say, that's pretty much what I thought on the. There was some stocks that really are looking like they're really breaking out, and I'd like to go through some of them as well. Might be helpful to the people that are out there looking for something. NVDA, uh, obviously, that had a nice correction into my stuff right down to the support at 113, 115, and it's really now it's above 130 and they have earnings coming up on the 26th. Can we put NVIDIA up there and get your opinion on NVIDIA?
yeah, we've got it. I can see it right now. Um, I have to admit, I sort of thought that this DeepSeek news might sort of render the Nvidias of the world a little bit sort of just given that, there's a narrative. Like, of course, all the tech companies have come out and said, listen, we're spending, spending, spending. No, not a single one has said we're going to pull back, which of course has played into reinvigorating Nvidia here, at least from those 115s. It's had a good $20 run. That's very impressive. So the sort of rumors of its demise related to CapEx were exaggerated, apparently. Um, Narrative is interesting, and I think there's a chance. I'm not a big fan of going along it at this point. I just think that the conversation has changed a little bit. And what that makes me think is that maybe at some point down the line, there is some fiscal sort of willingness to kind of do things more efficiently, perhaps not spend money. So what that means for Nvidia is, maybe margins get, hit a little bit. Not that they don't continue to be an important company. Maybe the potential for margins to start to contract at some point starts to make sense. And of course, the market is a great prognosticator of the future. So the question is, will it starts to sort of recognize that? I think this sort of bounce back is just kind of a reaction to, okay, App said, yeah, we're still going to spend $300 billion on CapEx, and not all on Nvidia, but on their own chips, on Google's own chips, things like that. But generally speaking, they did not express any particular alarm surrounding the money that they're spending on AI, which it kind of boggles my mind. I don't know. Do you really need to spend, $100 billion for a better chatbot? I'm obviously not well versed on AI enough to see how that money is really required, but that's not my job. So I think it's interesting. Um, I think other mags. I've really been positioning in things like Meta, a little bit in Google, in Amazon. I think those are sort of interesting to me because if if the hardware part of things, if so, let's call that the picks and shovels, right? The gold rush. Everyone goes to the store and they're buying picks and shovels, and the picks and shovel maker is going to do well regardless of who actually pans and finds gold. So they just sell it willy-nilly to anybody who wants it without regard for who's actually going to be successful. I think maybe we start to transition a little bit, and we've seen it to some of those upper layers, that next kind of layer in the stack, the AI stack, which I've felt has been a Meta and Amazon, where these are the companies that AI is nothing new to those companies. They've been doing it for almost the better part of 15 years. So this whole the AI is new thing is obviously ridiculous. They've been turning our eyeballs, our habits, everything about our personalities, about about everything that we do into into cash basically for a long time. So I think they continue to do that. They are able to harvest and monetize artificial intelligence immediately. Whereas other companies may be thinking, well, I better get on board. I'm not quite sure how this is going to work out for us, or if the money is going to be well spent, but probably is mostly money well spent in a few names like that. So that's kind of where I've been positioning. The Google hasn't really worked out lately because I think it's just got a few too many cockroaches. It's just got the regulatory overhang. It's got the chat GPT search threat. So it's got too many what ifs going on with it. And
Yeah.
that really highlights for the viewers, that really highlights how, you know, they're the cheapest of the bunch. I believe they're the cheapest of the bunch of the mag, but it doesn't matter, right? People will pay a premium for, fewer or no cockroaches. They don't want overhang. Meta doesn't have a cloud business to compete in, right? It just has all the pure um, positive storylines versus a Google versus a Microsoft that has Azure, which we've seen a bit of softening in Azure and some growth, and so you have those questions because of they're embedded in that sort of war of that cloud war. So Meta doesn't have that, so you don't really have any. There's no really talking it down except for the fact that it's gone bananas to the upside, right? Meta's run from um, my goodness, I think it was down around 450 in early August, and it's run all the way up to 720. So valuation starts to get, it gets overextended, certainly on a technical basis. I mean, valuation wise, it's not exceptionally expensive, but could I see it pull back $75? Yeah, for sure. And I hope it does because I'd like to put on some more plays. I've been doing lots of these risk reversal plays, Jim. You're going to know about these where you kind of finance some of this expensive downside skew. You sell some puts, some put spreads. You use that to finance some upside leverage. A great thing about that play is you're really harvesting the volatility edge that's out there, right? When you're selling something expensive to buy cheap upside, you're putting yourself in the position of taking advantage of option pricing, whereas on a caller, you're sort of doing the opposite. So a lot of plays like that have really been making sense as these continue.
Yeah, that strategy would have been ideal to do against that support that I talked about on Nvidia at 115. Sell something like the 105 put and buy the 115 call or 120 calls or something, and now you're up at 135. And if they get if they're going to announce a very big jump in revenue, and these guys have already announced a 40% jump in their expenditures, then that thing could go very, very parabolic here. Very interesting. I'd like to throw a few charts up there, David, that I saw breaking out and I thought were very good deals over the weekend. TSM. Now, if they're going to need chips, somebody's got to make them. So TSM looks to me like it might be breaking out to the upside. Do you have that? That's Taiwan Semiconductor.
Yeah, yeah, they're
Yeah, Jim, do you see it on screen? Is it?
I'm
Yeah.
not. I'm not seeing it. So that's not important. It's important that you see it and that
I see
Hans
it.
sees it.
I
Yeah,
see it, Jim. Yeah,
I already know what it looks like.
yeah.
Yeah. So, what do you think of that chart formation? What do you think it looks like?
I think it looks okay. I mean, you're starting to see a little bit of a bounce back, even in things like Dell,
Yeah.
where the negativity got just a little bit on the extreme side. I wouldn't be chasing charts that are generally poor looking like a Dell, but this looks interesting, and I agree with you. I think if you certainly feel that the capex boom is still on. Some of these things have pulled back, and I think the problem is, betting against the all the mags basically saying, look, we're still spending. is going to be a tough thing. So that's going to need to unwind a little bit, especially if we start to make our ways to S&P highs again, all-time highs, which I think we do. It's going to be very difficult to kind of bet against this kind of thing. There are a couple in there that I like ASML. That's the Dutch company that actually um, builds these massive, very expensive machines, mind you. They're like $150 million, but they are in a position that can really benefit from that reshoring, that onshoring, right? So I mean, look at what Trump's doing. He sort of sees this new world order, which was already in place to some extent. I'm not gonna blame him entirely because we've already seen an unraveling of globalization to some extent over the last several years. And so this, Russia, various reasons. So there's this idea in the CHIPS Act, there's this idea that countries are going to sort of go, listen, we can't be reliant on Taiwan. We can't be reliant on one company doing this or that. We need to be a little bit more self-sufficient. And I think that could be a trend. And I think that's good for other areas like infrastructure spending, things like that. I think this could be great money to be made. Power gen, we'll talk about that in a moment because I have some great uh, names that I love there. But in particular, this is a company, they basically have a monopoly on these machines that help you make these wafers, these chips, parts. And so I think the idea is that, look, at some point, people are going to have to just continue to order. Now, they did suffer. You see that big drop back in October. They did suffer from um, drop in orders. So I think that's presented an interesting opportunity for us. So I think that's one that may need a little bit of time to percolate a little bit to kind of to start to, sometimes when a stock takes a big hit, you have a lot of damage on the chart. And it takes a while. Think of it like a cruise ship. It just takes some time for that cruise ship to turn around and find that new path. So we need those moving averages to kind of the longer term ones to recycle and start to point up again a little bit. But for me, that's an interesting place to get involved. And to your point earlier about NVIDIA doing that finance spread when it came down to 115, the great thing about those environments is you get that skew, that put skew jumping up, right? You get people start to
Oh yeah,
panic and they're buying puts because they're
yeah.
they're they're worried. And so that's where you can really take advantage of focusing 99% on the left tail, which is the downside, forgetting about the right tail. So those puts can be used. You sell those to finance that upside. And that's really where the market could be giving you an interesting opportunity. Again, it's got to be a name that you really love. You're not just going to do it on anything just because it's plunging. It's got to be a name you've sort of been saying, man, I've been waiting for this moment to
Well, in NVIDIA at 115 would certainly fit that bill.
down from 152, 153.
Yeah, I
Not
mean,
expensive. It's not an
yeah,
expensive stock, that's for
yeah,
sure.
yeah. Another one that I thought looked very good was in the cybersecurity Zscaler, David ZS. And I'd like your opinion on what do you think that chart looks like?
I think that looks real nice. I think that
Oh
looks
yeah.
real nice. Yeah.
Hmm.
I think
And they have
I
earnings coming. They got earnings coming out on the 5th of March, so it's a few weeks away. But I don't
yeah.
think they're losing. I don't think they're losing money.
No, and there are a few names in that space. Palo Alto is one of my favorites. It's kind of, I think that's a nice kind of secular theme, right? So if you're looking from a fundamental standpoint, and as traders, maybe we don't always do that, but I think it's always important to do that, as it's you have that in the back of your mind. This is a theme that's got to do well, right? Cybersecurity, the world's not getting any safer. We've got, a different kind of Cold War going on various fronts, and this is very much an area where I covered this area for quite a long time in a previous role, and it's an area where there's still room for budgets to kind of um, expand. They're a bit under allocated to cybersecurity. I think it's going to be like having running water in your business. It's just you're just going to have to spend money to have a security system. And even though these companies sometimes get hacked, so clearly this is not an easy problem to solve when when the companies doing this also get hacked once in a while. But it merely highlights the fact that this is an important space where it's cops and robbers and there's no finish line, right? There's no finish line. You are merely trying to keep up with the crooks who are well equipped to continue to innovate and find new ways to do bad stuff. And so and from that perspective, it's a never ending stream of revenue for companies that can capture it well. And Apollo Alto does, incorporates AI into what they do. I think they're all going to do that at some point very well. But that's kind of where I stand on that whole space. It's kind of like it's one of those core thematic secular things that I really do like over the long run. Now, you can pick a stock and anything can happen to it. But or you can go with one of these ETFs that basically, own a basket of them. But I like the space, and the Zscaler looks real good. I believe Paulo's got some earnings coming up as well. So that's always what makes some of the plays tricky, right? You don't know whether you should stay out of it into earnings or just kind of pounce on it. That's the question.
Yeah, well, these guys tend to make money. Another one that took off pretty good was BBAI. BBAI.
Oh
And
yeah.
and that has a following. So that George Soros's theory of buy, and then when it goes higher, buy more. That could be something at play here. It obviously is at play at Palantir because obviously the way the traders are going, they bought, then they bought more, and went higher, bought more, and then they bought more. So sometimes these things don't come back down all the time, and BBAI could be a candidate for that same kind of thing. What do you think of that chart?
I think it looks good. I mean, my guess is it's a little bit more on the speculative side of things. So this,
Oh
you
yeah,
have to
oh
take it
yeah,
for what it is.
yeah, yeah.
But to your point, I mean, look at that RSI. It can't be much more overbought than that. Although,
Right.
I don't think that's how the RSI really thrives. It doesn't really. I don't think it's as good for overbought, oversold. What I do like about the RSI. For example, look there. You can kind of see where it comes back to the 50 line. You see the mid line there. We saw that pullback in December. We saw another pullback in early January where we dipped a little bit below, and then we saw another pullback just recently. So I kind of like that mid spot there on the RSI for when you have a trend. If you have a generally strong trend, that's kind of a nice spot to maybe you wait for that spot to get to 50, around 50, and that's where maybe you can kind of take a nibble or do something with options that is a little bit more limited risk. But yeah, that's interesting. And to your point about buying more, that's one of I can't remember who said it. I'm sure many people have said it, but a true sign of a good trader is the ability to add to good trades. And so that's where, these professionals really, really excel. They cut their losses, but they really press on those good trades. Is this a name I would do
Right.
that on? I don't know. I don't know enough about it.
Right. Another one that hit my radar over the weekend was Roku, ROKU. Wanted to get your opinion on how you think that chart looks.
Well, I love them. I mean, I use them at home, and I think it's become a great gateway for people who need. It's almost like as people cut the cable, they kind of need almost like an operating system. Well, where can there's a number of them, Fubu, things like that, and it's kind of where you just go, okay, well, I like ESPN, so I'm going to add that channel. I'm going to add this channel and that channel, and this becomes kind of your hub. So I really like them. Um, I think it's had a good run, but this is certainly an environment where the parabolas are continuing. That BBAI, another parabola. So I just think you have to be, I don't know what the valuation is on Roku, but I think you've got to be a little bit careful on things like this. But I would say a pullback to that breakout spot would be my preferred kind of entry rather than just chasing things up. I think that's a very strong entry. You get a breakout, you get and then you get the weak hands out of it who've jumped in on the breakout, and then it becomes sort of well poised to take another leg higher and use maybe like an 83 half stop to get out there. But I like that. I like that name.
Yeah, another momentum thing I saw was Cloudflare, NET, Cloudflare. That looked like it was really going over the weekend, and today I think it's doing pretty good today too.
Yeah,
NET.
that's one of the backbones of the internet. People don't really know it well, but it really, it facilitates everything that happens around the world, in a sense, from a connection standpoint, from a plumbing standpoint, if I remember correctly. So, wow, that's a heck of a chart. My goodness. So, Yeah, and you know what? They're kind of rediscovering some of the names, some of the 2021 names, the quality ones. We've seen big runs in Square and PayPal and some of the things that were, sort of left for dead for a long time. Um, I think that's kind of one of the interesting themes is that I keep telling students and clients and members that, don't just get stuck in your world of trading AMD or NVIDIA. For sure, there's probably going to be opportunities there, and there's certainly something to be said for trading things that do get a lot of attention. You get good liquidity, you get good spreads, things like that on your options. But don't be afraid. I've got a chart here that shows how you tend to get these last 2 years have been extremely, extremely highly concentrated rallies. And you, after 2 years like that, you tend to get a very big rebound. Now, whether it's this year or next year, we're not sure. I think it's this year because we've already started to see a little bit of a broadening out, which I think plays into the overall view that it's second half of the year, we start to realize that inflation isn't going to get too nuts to the upside. We're actually going to start to get maybe one or two cuts. The rest of the market, which needs lower interest rates versus the Mag 7 that doesn't care about rates so much, is going to benefit. And I think that broadening can happen. So if you look at those, only the last 2 years, the last time we had 2 years like that, where it was exceptionally highly concentrated in a few names, we had a very big reversion to where the broader market did well. And so I'm starting to position in some IWM, which I've played back and forth. I know it's been a bit of a, Russell's been a bit of a heartbreaker. You can kind of see since August is where I started to say, you know what, I think this is it. We're starting to see a little bit of broadening. And it's not for the faint of heart from an index standpoint, right? It can move around. But I think it's a place where we're going to push towards those old highs as the market starts to sniff out, um, you know, potentially that potential for some dovishness. Now, it's like you said, it's going to depend on we're watching CPI, we're watching other things that may we've got unemployment at 4%. Does that start? Does your wage pressure start to take importance in terms of playing into this scenario? But I like it, and you're seeing that, right? You're seeing people push into real world stuff. It was all digital. Now we're starting to see people push into the real world, right? Like things like I think things like Home Depot look good, right? Boring old Home Depot. It's not Nvidia. It's not whatever cybersecurity, but it's in an environment where there's this structural shortage of housing. I think I saw a chart the other day. It said the average age of a home in the US only gets higher and higher, right? Generally speaking, that takes a long time to kind of um, filter out. So 40 years is the average age of a home. Well, that means people need to maintain people, and especially if they're not moving. We know they're not moving because they've locked in 3% or 2.5%. So they need to upgrade. They need to fix. The wives are telling their husbands, "Listen, honey, if you don't get me that new dishwasher or whatever, a new backsplash, I'm going to kill you." So, the people are just spending to keep, to maintain, to fix up, to renovate. And I think that's good. And that plays into real world type stuff. Touch things you can touch and feel. I think some of those areas do quite well this year.
Hey,
Yeah.
while you were talking, I just had an idea of something that might kind of demonstrate what you were just talking about.
Yeah.
Um, RSP is the equal weighted
Yeah, I
uh,
love looking at that. Yeah, I
ETF.
like looking at growth
Um,
versus value. Samantha LaDuc loves to talk about that, growth versus value. She has a great chart that always she loves to
yeah,
zoom out, and I need to get better at that. Kind of go and just do the big zoom and go, okay, where are we on those multiple time frames? Because as traders, we kind of get lost in the noise sometimes. So it's good to just kind of go, okay, well, here's the big picture. I can trade within that picture, but let's not forget that, and that's kind of a nice looking chart. I think it has the potential to go.
yeah. That is interesting. How much more SPY or how much better it has performed versus the equal weighted
Well, that's the
uh,
2 years, right,
S&P.
David, that I'm
Yeah,
talking about. Like
yeah,
it's been out of this world. When we switch over to my to my screen. I'll show you guys that quickly, but it has been out of this world, and that's where everybody's focusing, right? And so sometimes, you know, someone will go, "Hey, have you seen the chart of Coke or whatever?" I mean, it's pulled back a little, but it went parabolic at one point. So you have these stocks just that people had forgotten because really the market's not that expensive. If you sort of back out the expensive names, which are maybe the mag and some things like that, and they're not even that expensive. I mean, they make all the money. So if you look at the rest of the market, the unwashed 493 that people had forgotten for a couple of years, there are some interesting opportunities. So maybe we sort of see this movement, this dispersion under the hood of the market, which I think could keep the VIX kind of lowish because maybe it's a matter of this thing's going up and this thing's going down, and there's people jockeying for position here under the hood, as opposed to everything kind of correlating and going in the same direction. So it may be a bit more of a stock picker's market.
Yeah.
Mm, yeah.
I was wondering, Hans, it might be a good idea to spend a few moments here to go over some of the things you're wanting people to go to the webinar that you're going to have, that they're going to learn at the webinar, and maybe some examples of, and David could put up a stock, and maybe you could give some examples of what you're trying to achieve on some of the different strategies.
Yeah, well, I mean, at the webinar, it's a 2-day webinar, and I'll show you guys in a moment with a couple slides, but we're going to be going over a full system that really starts with looking at quality. And so I kind of alluded to that a little bit earlier that, no matter no matter what you're trading, you really need to always keep in mind that when you're trading options, certainly as an option seller, you could end up owning the stock, right? If you're selling cash secured puts, well, you can end up owning the stock. If you're doing covered calls, you already own it, and you could own it on the way down as well once your calls, kind of run out. So there's always this idea that you're creating a bond proxy when you're doing these kinds of strategies, and because of that, you need to always be aware of quality, right? You just have to be, because it looks like a bond and smells like a bond because it's throwing off income that you're generating from covered calls or whatever it is. But really, it's just Tesla, right? And Elon's not going to he's not going to secure your principal. You're like a bond will. So the quality is always important. So we always start from there. How do you find them? And I have these sort of easy button approaches to, look, this is how you find them. And it's not that complicated. You don't have to spend 2 days poring over balance sheets, but you want to make sure that you've got cash flow and things like that. And then we dive into the fun stuff after that. So always good to really start from a solid foundation and have that be your kind of starting point. And it's always, we're always going to get tempted. We've been trading MicroStrategy positions in the community. I have a community as well. We've been trading Reddit. Does Reddit fit all the fundamental parameters? Well, in some ways it does, but for the most part, it's not right there. So you can always have kind of a bit of a fun part of your portfolio. Look at that. Look at that run that it's had. I just sold some today at 228 something. And then last week at 197, a little bit early. But this is a stock where it jumped to 114, and everyone said, how are you getting bullish here? I said, well, this is an $18 billion company. It could be a $100 billion company easily. This could be a mini Facebook. So this is a matter of a company riding a tricycle, just learning about what it can actually accomplish.
Right.
Now it's had a big run, so it's tough to say at this point. I still think it goes higher over time, but they've got earnings coming out in a couple of days, so going to be very, very important to see how they do.
Yeah. A lot of it might be factored in, but there's a big demand to access their audience because they have a unique audience, and that's what's really driving the thing nuts.
Very unique, and they're expanding around the world. They've got this translator that translates their website into 30 different languages. And it really is, I sort of thought of this analogy like it's just this little child. Like, that happens when a company goes from private to public. Suddenly they have access to all these people who understand how to monetize. Whereas before they were just kind of sticking to the one or two tricks that they know. And that's why many times this company goes public, And they get a new CEO who really understands this next stage, as opposed to a founder who really just sees things in a sort of siloed kind of way, unless they're exceptional, right? There are examples like that. So these are a lot of eyeballs that they can monetize. Um, and my kids use it, my wife uses it. I don't use it that much. But the potential is there for all kinds of wonderful things. So, but it's had a good run, so I wouldn't be chasing it here. That's for sure.
Do you tend to look for stocks that have been volatile, like a Tesla, like a Reddit, like a Palantir? Because obviously the call premiums have to be pretty healthy, and the trends are fairly strong sometimes. Do you go with those kind of stocks mostly, or more
I,
moderate movers like IBM or something like
More
that?
moderate, yeah. The core of the teaching is really sticking to stability, to consistent returns. So I show people a chart of, selling puts on. It was a Goldman study where they, selling puts on high free cash flow stocks outperforms doing it on the other, basket by a ton every year. So there's really, when it comes to the option selling game for income, I think, and I see it on Twitter, and I argue with people all the time. They're trading, they think the higher the vol, the better. Absolutely, smash it out. Sell puts on MSTX and all these crazy leverage plays. Um, I think there's a real risk to that. It's not about the amount of premium that you take in. It's combining that with a view of stability and quality that is going to make a difference over time. So I always tell people, well, you can trade options to make money, or you can trade to have fun, and I think both are totally fine. If the market is your Vegas, then go at it, have fun. But if you really truly want to make money, I've seen it too many times and this whole win rate thing. Oh, yeah, I've got a 95% win rate, but you still lost money. Well, yeah,
Yeah,
the win rate is always a good one, right? So
right.
you got to really, it's a slog sometimes. And it doesn't mean you can't trade fun stuff. We trade meta, I mean, there's plenty of excitement out there, but I tend to stay away from things. I haven't traded Palantir. I mean, they barely make any money, and I've been wrong to stay out of it. I've been involved in other things that have gone parabolic, but that's one where I just haven't quite gotten on board. Um, and you know what? Maybe I'm not au courant with the times. But we've done really well on Hood, right? So Hood's an interesting name where I just kind of see, I see the potential for a company like that to take over the wealth management business for the next generations. Like all these young people who are going to inherit, you know, hundreds of billions of dollars are not going to want to have relationships with their stuffy dad's advisor. They want to do things on their own. They want to get in there and they want a company like this that is always on the cutting edge, doing crypto, doing bets on elections, they want the fun stuff and they want it online. And so that's an interesting place where I think they just continue to take over um, a very, very big business. So I've been pushing that since about $20. It's doubled since the election. So, that's another one. I just took off a position this morning in our community because it's just had a good run and earnings are around the corner. So better to be prudent. I had an Amazon position. I didn't take it off and it pulled back $10. So it gave back a little bit there. So that's always a tough decision, right? Do you keep the position on into earnings or do you not? Maybe it does a Palantir and jumps 25%. Or maybe it unravels like a Google or an Amazon. So I'm not a big fan of selling options into earnings events. There have been plenty of studies that show that's not, it's exciting, but it's not, there really isn't a lot of edge in that. A lot of the time, you are actually on balance better off owning the straddle into an earnings event. I think we talked about that last time, Jim. So it's just making students aware of where the edge is and where it isn't. If there's no edge there or there's negative edge, then I run far away from that as fast as I can, and I let everybody else blow their brains out on that. So it's just about kind of understanding that success over time is avoiding those big piles of what as
Right.
much as it is kind of finding good trades. And I'm sure you talk about that stuff too, Jim, because there's so much noise and temptation. You just want to trade everything, and you just have to be a
Right.
little bit careful.
Let's throw Uber up there because I thought it was a very good deal in the 65 area, and it is starting to move a little bit last week. Yeah. Can you put the Uber chart up, David?
I see it right there.
Yeah, it's there.
I
So
love it.
is it? Yeah, I think this thing looks like the real deal Holyfield this time.
I 100% agree with you. It has been a heartbreaker. I've been a believer. Um, and I think it goes to 100. And I've been thinking that for a long time. So it hasn't worked out yet. I'm up money on it because I'm in around the mid 60s. I have some leaps as well. I have to admit I did sell some leaps just this morning. It's funny you're mentioning these stocks that I've literally just traded today. Um, but they're the real deal, right? I mean, they are a cash cow. I don't think Robotaxi is as big a threat. I think they're on board with it, um, very much on board, and they have a unique um, brand that effectively has a kind of a monopoly. I mean, there's kind of an oligopoly, but really Lyft is sort of, to me, Uber is Netflix, right? Disney's losing tons of subscribers, which I don't think anyone expected. Netflix won the battle years ago. Uber won the battle years ago. Now, can they be smart about it? Can they turn that into something fantastic with new revenue streams and expansion? Absolutely, I think they can. So I think this is a name that can go. And now with Ackman in it, he agrees with me. I always like it when Bill Ackman agrees with me. He didn't call me, but I'm still waiting for his call to hear my opinion. But look, not that he gets everything right, but I do feel that this is a solid place to be. There are some variables out there, right? This robo taxi thing, but they're too well positioned to. I feel bad for the Uber drivers, but at some point that is going to become a reality.
Yeah, a stock that had a great week
Um,
last week. Yeah.
someone in the live chat asked about the inverted yield curve. Do you have any thoughts about that?
Yeah. What do you think, Jim? Inverted yield curve. Well, we're back, right? We've uninverted. Where are we now?
Yeah, like I say, I looked at my Vanguard account and I looked at the interest rate bar, and I was a little surprised to see 431 in the 3 month T-bill, because I think that's pretty high, and obviously it must have gone above the 2 year, and that's what he's talking about. I think that what it's saying is exactly what I was saying, which is there is a risk on this inflation. I mean that jobs number. I mean, 0.5% hike in wages annualizes out to a 6% hike in wages, which is way higher than the inflation rate. And people love spending their money. A firm and upstart confirm it. So they're out there spending. I mean, if a restaurant went and took a $17 entree and moved it to 23, as long as there's a line wrapped around the block, are they going to go back to 17? So the
No.
bottom line is I think there's a real risk here for the inflation to come back, and I think it's inverting because they are a little concerned about it. If the CPI were to come out, it's supposed to come out 2.9 annualized. If it ever came out at like 3.5 or something way out of line on Wednesday, that would be very much disruptive to the market. So like I say, the inverted thing, if you want to know why it's happening because people are becoming more concerned about inflation. And if in fact inflation were to pick up, they're going to have to they're going to keep the short-term rates where they are. And God forbid, they may even have to hike them if we saw a 3 print and started to move towards 4 print on inflation. So
Yeah, that's gonna and one of the issues is just to sort of side with that is you've got this immigration issue that's happening right now. Most of those people have been working in agriculture, in construction, and I think that does put pressure on the construction industry. So um, I know these things don't move very quickly all the time, but there are some people who think that the sort of rental rates are coming down. The shelter numbers will be coming down. There is the potential for that for a wrench to be thrown a little bit into the machine there and slow that down, especially in a building industry and a housing industry that's quite structurally challenged right now because of all the way back going back to the global financial crisis. We've had this problem. Um, so you can see the home builders actually breaking down lately. The DH Hortons, the PHM not doing great. I mean, I think the ones that can make the little homes, the little custom homes, are going to be okay. Dream Finders Homes is a company that I don't mind there, DFH, which is kind of like, but it's definitely a little bit more spec. But I think they're able to maybe satisfy, because you see what the home builders are doing is they've got to compete on price. So they're building smaller, they're giving you, you know, less finishings. It's, they're able to kind of customize to fit the price point that they want to present. So there is some value there. So I'm wondering if there's a time to step back into the home builders at this point. Maybe if, as I said earlier, if we start to sense that rates are going to come down a little bit, which is really what the secondary market needs, right? Until that happens, it's just that market is really quite frozen, and really the home builders kind of have the run of the mill there. But the stocks certainly aren't reflecting that, because they're going to have
Well,
problems with this labor, supply is going to be an issue for them.
you said you had some slides for the webinar you're having. Do you want to put those slides up now?
Yeah, let me throw that on here. Um, I just sent you a little request.
Okay, you should be able to share now.
I do. Somebody said, do you really think rates are coming down? Yeah, I really think, I mean, I could be wrong on this, of course, like anything, but I really do think that much of what we saw was very much supply chain related. I mean, think about the previous decade. Now, I'm also sort of contradicting myself maybe, because the previous decade was still in that sort of cheap labor, cheap goods coming from all around the world that kept inflation down. But we just couldn't get inflation going. It was really COVID that broke things, that really caused, I think, the bulk of the inflation. And while I think 2% is just this stupid level that they're going to have to give up on at some point. While I don't think it comes down that much, I don't think it gets going again unless we do have that some sort of disruption again, lead to something like we experienced. But I stand to be proven wrong. But so anyway, guys, here's my master class, enhanced wheel master class this weekend. It's going to be Saturday and Sunday, 1 p.m. each day. They're going to be recorded if you can't make it. But we're going to go 1, 2, 3 hours each day, just going through the full system of how we approach looking for stocks, how to look at them from a technical standpoint, really going over the whole philosophy of what we're doing and how to stay out of trouble, and then really getting into volatility as well. So you're not going to see this in many programs, many courses. Like, I get into where's the edge, what are you looking for? I take data. I am always supported by data. What kind of environments do you press the pedal on? What kind of environments do you pull back on, even though the option premiums are nice and juicy? So we use something called volatility risk premium. So that terms like that will no longer be, Chinese to you after you take something like this. So it's going to be 2 days, going to be really, really wonderful. We'll go over things. I'm going to teach you my turbo strategy, where we did about 6 or 7 trades on Reddit. So everything, cash secured puts, covered calls, risk reversals, call spreads, long calls, all kinds of stuff. So you really, in the program and in the community that I have, we learn to do everything. Because if you just do one thing all the time, I remember on my floor trading days, there were some guys who did one thing really, really well. And when the environment changed, they were done. One guy ended up driving a Greyhound bus for the next 10 years. Not that actually it was through the mountains though. So I'm almost envious of him. It was probably a beautiful drive every day. But my point is that you've got to be a well-rounded trader. And I don't mean doing silly things like doing 1-1-2s and downside put ratio spreads for unlimited risk and S&P cash market, stuff like that. Keep that stuff. There are great strategies to use, but know how to read them, how to pick the right ones, how to use the Greeks properly. And that's really what we're going to focus on. So crushthepremium.com/training. You should find all the information there. It's like $397 for this. And you get like 2 months in my community. You get my MTI indicator to keep forever. You get my Nomad course. You get my Volatility Ninja course. It's kind of ridiculous. You get tons and tons of stuff. Next time it'll be at least 50% more, maybe double. So drop in. If anyone wants to learn a bit, drop in. And we start from the very beginning. So from the beginning, all the way from beginner to pro. So at least that's the idea.
Sure. Sounds like a great opportunity to take advantage of. No doubt about it, Hans.
Thank you,
So
Jim.
I wish you well with that. As far as Option Professor is concerned, if you'd like to find out what I can do for you regarding our weekly options alerts as well as coaching, and things like that, you just go to Option Professor. I think the link will probably be up there when David's there. Or you can shoot me an email at optionprofessor@gmail.com, and we can set up a time where I could speak to you specifically on it. But yeah, the comprehensive education is really a very helpful thing to do, Hans. So I think that's a great opportunity for people to learn more.
Absolutely, Jim. And you know what? I love option professor stuff. Fantastic as well. And you know, one of the things that people always, students always say at the end of it, they say, you know what? My confidence is better, right? It's one thing to go on YouTube and learn this strategy and that strategy, but I find a lot of people are, many students, when they start out, they sort of say, I'm kind of scared. It really takes them a while to kind of get to that comfort level, and it's really about confidence. And once they build that confidence, it's amazing to see how people just flourish after that. Doesn't mean you always hit it out of the park, but confidence to know what's going to work, what might go wrong, what, how to adjust, all those things just gives you the framework for how to react in this multi-dimensional world. So you and I help to increase people's confidence. That's one of the great things about education.
Yeah, and very rewarding for us as well.
For sure.
Yeah. All right. Well, thanks a lot, Hans. We'll be talking soon. Thank you, everybody, for being here. Let's have a great week. Let's see what CPI and the full moon does on Wednesday. It's probably going to be a pretty wild Thursday and Friday. So stay tuned. And David, I'm going to send it back to you.
Thanks, guys. Thanks, David.
All right, thanks, guys. Yeah, great show today. So, just a quick announcement for everyone. We are having one of our AYT events this week. That will be tomorrow, Tuesday, February 11th, and then Wednesday, February 12th. And if you're not familiar with that series, it's no presentations, no set agenda. It's just great analysts answering your questions and looking at charts that you want to see. So join us on timingresearch.com for the next 2 days, and that's always a fun event. So also, just a reminder for everyone, be sure to subscribe to Timing Research on YouTube and your favorite podcast app. Uh, also, you can find Timing Research on Substack if you're on there to get access to the presentations and archives for all Timing Research events. So I just want to thank my panel again for today, Hans Albrecht of crushthepremium.com and the Option Professor of optionprofessor.com. Thanks, everyone.